Most people think sitting in cash is safe, but the truth is, cash loses value every year to inflation. That means while you work hard for your money is quietly shrinking in the background. Stocks are the opposite. They're not just pieces of paper. They're ownership in the most powerful wealth-building machine in history. If you had invested just $500 a month in the US stock market since 1990, you'd have over $1 million today. That's why we call stocks the engine of growth. When you buy a stock, you're not gambling. You're becoming a part owner of a real business. If you buy into a tech company, a bank, or a retailer, you own a slice of its future profits. That's why the word for stocks is equity. It literally means ownership. Think of yourself as a silent partner. You don't run the meetings. You don't design the products. But when the company grows, you benefit. If the company pays out profits, you get a piece. If it reinvests those profits and expands, your share becomes more valuable. And just like any business owner, you also take on the risk. If the company stumbles, your piece shrinks in value. That's why stocks can be both the greatest builder of wealth and, for the unprepared, a source of painful losses. Stock prices may look random, but three main forces drive them. Company performance. The stronger the earnings, the higher the value investors place on the business. A company that doubles its profits often sees its stock price rise dramatically. Investor psychology. People's emotions can push prices up or down in the short term. Optimism inflates bubbles. Fear creates crashes. In 2020, fear over COVID sent the market down over 30% in a single month. The bigger economy, interest rates, inflation, and growth all shape the environment businesses operate in. When the economy is strong, companies thrive, and stocks reflect that. In the short term, markets are unpredictable, but in the long term, company growth and economic expansion are what push stock prices higher. Not all stocks behave the same. Broadly, they fall into two groups. Growth stocks. These are companies that reinvest profits to expand aggressively. They're the innovators, the disruptors. They can turn small investments into fortunes, but they're volatile. Their prices swing wildly. Dividend or value stocks. These are mature companies with steady profits. Instead of reinvesting everything, they return some cash to you, the shareholder, in the form of dividends. They grow slower, but they provide stability and consistent income. Growth stocks are like a rocket ship, fast but unstable. Dividend stocks are like a steady train, slower but predictable. The best portfolios blend both. Here's the uncomfortable truth. Stocks can and do lose money in the short run. Individual companies can fail. Entire markets can crash. Enron, once a Wall Street darling, went to zero. The global market lost nearly 40% in 2008. This volatility, these sharp price swings, is what scares people. But history proves something powerful. Over time, markets recover and grow. Since 1926, the US stock market has returned about 10% per year on average, despite wars, recessions, and crashes. Every single crash looks terrifying in the moment. But on a 30-year chart, each one looks like a tiny dip in a rising mountain. The key isn't avoiding volatility, it's surviving it. The biggest mistake beginners make is trying to pick the winning stock. Even professionals fail at this. Most investors are better off owning the market itself, buying into a fund that spreads your money across thousands of companies at once. That way, your success isn't tied to one company's fate, but to the long-term growth of the entire economy. How much of your portfolio should go into stocks depends on your age and goals. Younger investors, under 40, can afford to have 80 to 90% in stocks. You have time to ride out downturns. Older investors, 50 and above, may want closer to 60% stocks and 40% bonds. The bonds soften the impact of market crashes, giving you stability. This balance is what allows your money to grow while also protecting it. Here's where urgency matters. Time is the most important factor in investing, not timing. Start investing at age 25 with $500 a month, and you'll retire with over $3 million. Wait until 35 to start, and you'll retire with just $1.2 million. That's a $2 million penalty for waiting 10 years. Every year you delay isn't just lost money, it's lost compounding. That's why starting now is always better than starting later, even if you can only invest a small amount. 3 traps to dodge. Timing the market. No one knows short-term moves. Missing just the 10 best days in the last 20 years would have cut your returns in half. Chasing hype. Meme stocks soared and collapsed. Most late buyers lost money. Not diversifying. Putting all your money into one company is gambling. Buying the whole market solves this instantly. There are 2 things new investors should be especially careful about. 1. Penny stocks and pump and dumps. Penny stocks are very cheap shares of small, often unknown companies. They trade for just a few dollars, or even cents per share. The danger? They're thinly traded and easy to manipulate. Scammers run what's called a pump and dump. They hype the stock up, drive the price higher, and then sell everything. When they dump their shares, the price collapses, and ordinary investors lose. History is full of these schemes. They look tempting because the prices are so low, but in reality, most penny stocks end up worthless. 2. High-frequency trading, HFTS. High-frequency trading firms use supercomputers and algorithms to buy and sell stocks in milliseconds. They're not investing, they're exploiting speed. As a regular investor, you cannot and should not try to compete. The good news is, you don't have to. They fight over tiny fractions of a cent per trade. You're playing a different game. Long-term ownership, compounding wealth, and patience. The takeaway: stay away from penny stocks and ignore high-frequency trading. Stick with diversified, long-term investments that align with your goals. That's where real wealth is built. Investing in stocks is less about finding secrets and more about adopting the right mindset. Stocks reward patience, not prediction. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." When you invest, you're not just trading dollars. You're buying ownership in human progress. From technology to medicine to consumer goods, every breakthrough pushes the market forward. By owning stocks, you own that future. Here's your next move. Open a brokerage account. Buy a broad-based fund that represents the whole market. Set up an automatic monthly contribution. Do it now, not tomorrow. Every month you wait costs you thousands in lost growth.